Good afternoon. This is Joe Lucey with this week's Market Huddle. Are you aware that 96% of all Americans on average lose up to $111,000 when it comes to their Social Security benefits? Now, that's according to Forbes magazine, who released this study last year. And that's why I wanted to make sure that we took some time, spend some time here talking about how to fit in Social Security with your retirement planning, and how we're going to make sure that you get this part of the equation right. Because in my opinion, Social Security, it has to be the foundation of an income plan, and without income, there is no retirement. I say it just about every week, but most families hire us here at Secure Retirement Financial with the number one goal in mind, to make sure that they can maintain their lifestyle throughout their retirement. Number two, if I can show them how to reduce taxes, that's important. And the third thing is, how do we make sure we grow the wealth without the compromise of those first two areas? And Social Security and the planning we do around it is absolutely essential into making sure that we address those first two issues: income that's going to last a lifetime, maintaining your lifestyle, and reducing taxation. So without any further ado, I'm going to go ahead and turn off my camera here, and let's dive into Social Security here this week. Oops. There we go. Here's that disclaimer we give this each and every week. Basically, keep in mind, especially when we start talking about Social Security, there's a lot of components to Social Security around taxes. I'm a tax planner. I'm not a tax preparation expert. I don't interpret tax code. However, we look at how your investments, how the income is going to hit your 1040 every year as you file taxes in retirement. And by rearranging those assets from time to time, we can make a substantial amount of savings. And I think you're going to see here as we go through that Social Security certainly has a big piece of that, and the way that we can help families substantially reduce taxes. Also, I'm going to be talking about Social Security. If I say anything here today that makes it sound like I'm actually taking this information and I'm a part of the Social Security Administration, I am not. I don't work for the government. I am the CEO of Secure Retirement Financial here, and we believe that taxes and Social Security and the planning we do around that is essential, but I by no means am affiliated with the federal government. Now that we've gotten the attorney stuff out of the way, let's move on. Social Security has what they call the Program Operating Manual System, POMS, or they call it the POMS. So it's the Program Operations Manual System, and there are 2,728 rules around Social Security in the POMS manual. Now, on top of that, there are literally thousands of additional rules around these rules, and navigating them can be somewhat tricky. Keep in mind that if I go to the Social Security Administration, by law, they are not retirement planners. They aren't able to give us financial advice. All they can do with the Social Security Administration is tell us which is the best way to take Social Security if I take it today. In fact, if there's we've had literally numerous cases here where families have gone to the Social Security Administration, they were told to take it one way, and it was once we came back and we sat down with them that we showed them that by rearranging the way that they take their Social Security benefits, it could mean tens of thousands, if not hundreds of thousands of dollars of extra income. They then go back to the Social Security Administration, and they've been told that Social Security Administration, by the employees there, that they really aren't allowed to give that information, and that's why it was omitted when they visited with them the first time. So keep in mind, when it comes to the rules around the rules, you want to make sure that you're working with somebody that understands how Social Security works and how it fits into an overall income strategy, like we do here at Secured Retirement. The traditional rules of thumb that you've probably heard of, where the longer you wait, the more Social Security benefits you're going to get, those are really no longer the case. In fact, what we often find are families are trying to meet, or they put together some kind of planning around maybe an article they read, or maybe just kind of a cookie cutter solution. And when it comes to Social Security, that's farthest from the truth. You need to make sure you're getting a tailored approach. At the end of today's presentation, as always, we're going to make sure that whether you're an existing client and just want to review your Social Security, or maybe you're somebody that's not a client, and maybe somebody has forwarded this on to you. I want to make sure that you are comfortable reaching out to us and scheduling a review. And I want to make sure that we help you get this right, because while taking your Social Security benefits too early can have a substantial impact on how much income you're going to take from Social Security, waiting too long because of things like mortality risk and things generally doesn't necessarily give us the best probability statistically to optimize our benefits. And the biggest problem is this: getting your Social Security benefits wrong. Like they were saying in that Forbes magazine article that I started off, where 96% of Americans are leaving $111,000 on the table, and it's due to poor timing. And also on top of that, it impacts so many other areas. It can impact the amount of taxes that you pay when you're taking the money out. It can have an impact on whether or not you're paying higher Medicare premiums, what's called IRMA, income related to Medicare adjustment amounts. There's just so many different things that come into play here. And if 96% of Americans are getting it wrong, well, that means only 4% are getting it right. And we want to do our thing here at Secured Retirement, make sure you're getting this right, and make sure that you get a tailored Social Security analysis that's going to make sure, number one, that you're getting this right, and number two, make sure that we're looking at the net income that you can receive. It's not just about the gross amount, but it's about the actual after-tax income, which really kind of leads us to the second point I wanted to, it's actually going to be the third point. Here, we'll bounce back there, and then we'll come back to this slide. See, Social Security by itself is 100% tax-free. I say that, and a lot of times I get challenged on it, but it's absolutely the case, because the way that Social Security income gets taxed is based on what's called a provisional income. It's a calculation that's done by with your accountant, or it's done with your tax return. And what they do is they take half of your Social Security income and then they add it to the other sources of income, things like rental income, pensions, required minimum distributions, dividends, interest, any maybe part-time wages, whatever that is in retirement. They're going to add all of that into only half of the Social Security benefits. And then when you hit certain thresholds, they decide whether or not that Social Security income is taxable. So a single person above the provisional income, again, half Social Security and these other sources of income above 25,000, or a married filing joint couple above 32, start to pay tax, or part of up to 50% of their Social Security income becomes taxable. When you get above 34,000 or 44,000, is then they start taxing up to 85%. So a lot of families aren't aware of this. They think that their Social Security income should be tax-free, and I believe it should. You're already being taxed on it once when you pay it through payroll taxes as you're working, but they aren't aware of how this works and how they can manipulate their tax returns, not manipulate, but how they can structure their payments onto their tax return to try to keep as much of this tax efficient, or in the best case scenario, completely tax free. Because when we have a couple that has, let's use a bigger number, $70,000, $80,000 of Social Security income, if that's all the income they ever needed, half of that would be, it's a married couple now at $80,000, half of it's 40. Yep, I understand that's above the 32,000 where they start getting taxed. But the amount that would be taxed is that 8,000 with 4,000 of their Social Security. Remember, we get a $12,000 or $24,000 standard deduction. Social Security by itself is 100% tax free, but you have to understand how to restructure things, and that's that's oftentimes what I say. That's our jam here at Secured Retirement. We want to show you how to reduce your taxes in retirement. And understanding that Social Security can be a very tax efficient way to do so is very important. Also, keep in mind that up to 40% of your income in retirement is expected to come from Social Security. That's according to Motley Fool. Says the average earner should expect Social Security to replace about 40% of their wages. Well, then what if that other 60%, you said, Joe, that's all going to be taxable? Well, not if we restructure things now. You know, I believe taxes are on sale. I think we're at 40-year lows right now. I believe that by making some smart and savvy changes to our Social Security and the other sources of income we have, we can make a substantial difference in the overall amount of taxes we're going to pay. The thing is, it's like a milk carton there in the fridge. There's an expiration date on it. We already know that expiration date is very likely going to be January 1st of 2026. But if you're paying any attention to the current administration, they are threatening to raise taxes on anybody that's over 400,000. We're going to go there. If you believe that that's really where they're going to stop, I'm going to start, and nobody's going to be impacted beyond that. I probably have some land I could sell you down in Florida, because here's the thing. If they went to everybody that was making $400,000 a year or more, and they took 100% of the income that they were making above $400,000 a year, the amount of taxes that would be generated on that additional tax from what they're currently collecting is somewhere in the $800 to $900 billion range. Well, that sounds like a lot of money, Joe, and it is, but we just tacked on $4 trillion. So it doesn't even cover 25% of that. We're talking about another $2 trillion probably, or potentially for infrastructure. It sounds like there's going to maybe some pushback on that. They started off at $4 trillion. Either way, in the last 12, 14 months here, we have tacked on anywhere from $4 to $6 trillion, and we're probably going to be tacking on more. So even if I took 100% of the income of everybody making over $400,000 a year, it doesn't even make a dent to what's been added here over the next few months. So that's why I think it's important to understand that taxes are very likely going to go higher. And one of the ways that we help families substantially reduce taxes in retirement is by optimizing this tax efficient source of income, Social Security. I promised you I'd go back to the foundation of mailbox income. I think Social Security is got to be the foundation of income in retirement. As I said earlier, Motley Fool tells us that 40% of Americans should plan on, that Americans should plan on Social Security replacing up to 40% of their income. But we oftentimes see a situation where families can replace far more than that. The trick is to make sure that we look at what is mailbox income and what is not. What's mailbox income, Joe? Well, mailbox income is money that's going to hit the checkbook each and every month, regardless of what's going on in Wall Street. So when we have two couples, let's say I have a couple, they both want to spend $100,000 a year in retirement, where one couple has the vast majority of their income replaced by things like Social Security, possibly a pension. When the markets have their little shakes and what have you, like we saw a year ago, back in March 23rd, when the market hit 18,500, they can sleep better at night because they know that the money is hitting their checking account each and every month, regardless of taking out withdrawals from their 401ks. If I compare that to another couple that maybe takes Social Security right away, but now is taking $40,000, $50,000 a year out of their retirement accounts, well, they're going to lose sleep at night. Why? Because, they are now locking in losses when the market has a correction. One of the tricks to making sure that you can spend in confidence in retirement, one of the tricks to make sure you have a secured retirement is to try to optimize your mailbox income. It's a fine line here. Too much mailbox income can also be a problem because you end up paying tax on money you're not spending. Again, most families want to maintain their lifestyle. However, not having enough mailbox income makes it so that you're much more susceptible to market corrections along the way in retirement. And the worst time that can happen is within that first 10 years of retirement. Whether you are 60, 65, or 70 when you retire, a major pullback in the markets early on where you're forced to tap into these accounts, locking in losses, you'll never recover them. It's called sequence of returns risk. So optimizing things like Social Security, where 90% of us have access to it, either through our own work history or a spouse's work history, is really the key to making sure that we can spend in confidence and that we can sleep well at night as we are going into retirement. So that's what we like to do. How do we do it around Social Security? I'm going to skip through the tax stuff. We already talked about it. What we can do for you is we can make sure we take these statements that you have, and we will put that into our system, and we will show you the optimal time to get Social Security benefits. I can tell you that if you go online and you Google free Social Security calculator, more than likely there's a half a dozen that'll pop up. the Cliff Note version of what they're all going to tell you is this. They're all going to tell you to wait till age 70. And I'm going to tell you that if you listen to that, you're probably going to leave a substantial amount of money on the table. Because by waiting till 70, what happens is if statistical mortality comes into play, you had a whole lot of checks that you weren't able to collect, and then all of a sudden you have both of you on a check, and then maybe something crazy happens. Martians take one of you away, and all of a sudden there was a whole lot of opportunity that wasn't taken. Now, with that said, it doesn't mean you should run out right at 62 and take your benefits, or even at full retirement age, 66 to 67, depending on what your birth year is. What we want to do is we want to look at all the different age groups. Let's look at what happens if one of you goes to 70 and one of you takes it early. What about if one of you takes it at full retirement? Or what if you both take it at full retirement? Let's run through all the different gyrations there. Again, there's a substantial amount of differences of way we can do that. And then we can calculate which is the best way for you and your family by using a tailored approach. And the only way that occurs is if, unlike those online calculators that are only looking at two numbers, what's my benefit at a certain age, we want to make sure we look at the rest of the picture. Let's look at the retirement assets that are sitting in the 401ks. Do you have other money sitting in savings? Are there other income sources, pensions? Is there going to be a sale of anything? Things like this that can come into play that can really help us tailor the best approach or the optimal approach for you and your family. And what we'll do then is we'll kick out a little report like this. Notice here, it's going to be hard to see this on the screens, I think. Notice that what happens here is that the software is going to kick out these four different, well, they kick out two of the four strategies. Our team that are specialists when it comes to Social Security will discover for you what the other potential options are. But in this case, there's a net present value of the of taking it at age 70, that's the blue here, of a little over $1.2 million. 1.2, oh boy, I think that's 1.290, and notice that if I take it in the yellow here, it's a 1.262. It's a little less than $30,000 over a 30-year retirement. That's the difference. Again, the maximization strategy that the online calculator is going to tell you to do is the blue. And if you both don't make it past age 85, or maybe after age 85, you aren't doing as much travel, you aren't spending as much, your lifestyle cuts back, while it might give you the most income, it doesn't necessarily give you the most income when you may need it most, which is earlier on. And notice that both the yellow and the green, which are far more likely to happen in the average retiree, is that they're going to fall within those categories. That's a break-even analysis down there. Let's look at green, let's look at yellow, let's look at blue, and let's make the best decision for you. What I want to do is I want to make sure that we have everybody that's on the call here. A couple things. Number one, I want to make sure that you can schedule your 15-minute review. I see a lot of clients on there. Steve, and I got Diana and David. And anyways, most of you have seen the analysis. Let's touch it up. Let's make sure that it still fits best for you, because it's about optimization and tailoring, not necessarily maximizing Social Security. It's about how do we make sure it fits in with you. The other thing I want to do is I want to make sure that everybody that's on the call today has a copy of my book that I wrote, The Retiree's Social Security Guide. It's a blueprint to maximizing your mailbox income. And if you have not received a copy of this, if you a lot of you have received it when you come in the office, or maybe you have somebody you'd like to pass it on to, reach out to us here today. Send us an email at info@securedretirements. I'll make sure that we either set aside a copy behind the desk for you, or that we send it off. We'll just, we won't overnight. We'll just mail it off here today. You'll have it by the end of the week, and then you can read through this. The other thing I wanted to make sure we did is make sure that everybody is aware that we can schedule some time. And to do that, you just need to click on that link that should have popped up there. What that'll do is it'll schedule a 15-minute phone call with somebody on the team here. We can talk a little bit about your specific situation and decide what to do from there. Sometimes that's just running through the analysis. We can do it all virtually or face-to-face. Sometimes it's about doing a little bit deeper dive into the overall retirement strategies. But we want to be a resource. We want to make sure that you're part of that 4% that gets Social Security right for you. And part of the way to do that is becoming informed. So let our team help inform you on how to best take Social Security. Get a copy of my book there by emailing me at info@securedretirements. and I'll make sure I get you a copy in the mail here today. And boy, that's really all I have this week. I guess just to kind of recap things, deciding when to claim Social Security is one of the most important financial decisions that I think most people have to make in their lifetime. And the reason why is there are oftentimes up to hundreds of thousands of dollars at stake. Only 4% of Americans are getting this right. That's according to Forbes. I want to make sure that those of you that are on the call are part of that 4%. Don't be part of the 96% that are going to make mistakes. It can cost the average person up to $111,000. So if you have a plan in place and would like to review it, click and schedule some time there. If you do not have a plan, let us give you the report. Let you get the TaxSmart retirement analysis and get a complimentary secured retirement Social Security analysis as part of that process. Let's make sure we get that right. That's all I have time for here today. A little quicker than maybe the last couple. I heard that Ryan did a great job last week. I know a lot of you are listening each and every week, so thank you for that feedback. And let me see if there was any questions before I sign off here. If you do have a question, don't be shy. Go ahead and send me something. Kurt, what and when do you see changes to the Social Security coming? First of all, Kurt, I don't think that they're ever going to completely eliminate Social Security benefits. If they were to do so, we are then taking a self-funding program. Yes, it's not 40-to-1 like it used to be. It's somewhere about 2.5 or 3 people paying into the system that are receiving. But if I remove that payment, that repayment process, and I took care of and I eliminated it altogether, with 40% of our income in retirement, that's the average person is going to need to replace 40% with Social Security. Coming from Social Security, I now took over half the households in America and I just put them onto another government program called welfare. I just don't see it happening. Now, with some changes I do see happening. Number one, we already know that the President Biden's proposal is to start taxing 100% of Social Security benefits for families making over $400,000. I don't think that's where they're going to fall. I think they're going to reduce that number to something that's going to hit a lot more folks that are on the call here today. So it's about looking at how much of that Social Security will be taxable. I personally think, and again, I have no crystal ball. I don't work for the government. Remember my disclaimer up front that I don't think that they're going to eliminate this provisions in Social Security that are tax-free. And the reason why is this. The IRS cares very little what your net worth statement is. All they typically care about is how your income hits the tax return. And if I can remove some of the taxable income by repositioning assets in your portfolio today, we can continue to keep Social Security tax-free, because when they started taxing Social Security way back in 1983, and then changes that came in under Bill Clinton in 1993, none of those numbers have ever changed. There's never been a cost of living adjustment. There's never been any inflation changes. When they first started taxing Social Security back in 83, it only impacted 4% of the American population. Now more than 40% of Americans are paying tax on their Social Security benefits. So I think that they're going to raise the taxable amounts. We had a 1.3% cost of living adjustment last year. I think they're going to continue some of the other hidden taxes, like the income related to Medicare adjustment amounts and things like that, where you pay more Medicare premiums than somebody else. But I don't see Social Security going completely away. And if they did, I imagine it would probably be somewhat higher than this 400,000 that they're talking about. So hopefully that answers the question. If anybody else had another question, I'll give it another minute here. Otherwise, we will just wrap up for this week. I want to make sure you're comfortable. Give us a call there on the number on the screen there, the 952-460-3260. Email us at info@securedretirements. I want to make sure you get a free copy of my book that I authored. If you've already read it once, that's fine. I'll send you another copy, pass it on to somebody you think would benefit from it. And we can mail it to you, or you can pick it up in the office, whatever works for you. All right, with that said, I hope everybody else enjoys the rest of their week. It's nice weather, huh? We're pushing 80, I hear, today, and then it's going to get a little colder again, but I think we're done with the snow and all that fun stuff, so that's good. Kind of feels like spring in the air. So with that said, everybody enjoy the rest of your week and have a good rest of your day today.